Thank you. Thank you very much, Reed, and thank you to the New American Foundation and to La Raza for hosting this gathering on this important topic of asset building, wealth building, and specifically the most powerful instrument of asset building in American history, the humble home mortgage. I must say I really became persuaded about the power of ownership when I was at Habitat for Humanity. Habitat was in an inner city community that was afflicted by poverty, concentration of poverty, by crime, by the crack epidemic. And as I worked with families en route to the possibility of home ownership and became very familiar with the community, I saw that there was a real difference between the families that had succeeded in being homeowners and those that were renting. They were each paying more or less about $500, $600 a month for their housing. But that is where the similarities ended. The renting family was at the mercy of the landlord for basic upkeep, which was often subpar. The renting family had to live under the rules of the landlord, which often meant you couldn't paint the house the color you wanted or plant the things in the yard that you would like. And they had to worry consistently about rent going up or being evicted. While there was a real empowerment among the home ownership families, they had the responsibility for upkeep, and they expected their children to help out, which changed the attitude in the family. They were masters of their own domain in terms of what they wanted their yard to look like or how they wanted their house to present itself. They had their monthly rent locked in for 30 years, and the knowledge that thereafter that they would own the house outright. And they were establishing wealth, both as their equity grew through their mortgage and as the value of the house increased. They were also in a position where the possibility of gentrification wasn't such a threat. For the renting families, it meant that their rent would go up to the point they would have to move somewhere else and be dislodged. And for the ownership families, it meant the value of their house would increase, and that was a very different situation to be in. I became involved in a project called Project Down Payment, because since houses were relatively inexpensive and since down payments were the major obstacle, I proceeded to work with others to try to establish a down payment fund. The 2 years that it took us to assemble that fund, though, the prices in the community went up substantially. And in many ways, we missed the opportunity. We missed the window where families could move from renting to home ownership. And that community is now, as I speak to you 20 years later, highly gentrified. The homes that we were selling through Habitat for $30,000, some of them are worth $250,000 or $300,000. Those families gained enormously, while renting families are largely been moved out by the economic forces of higher rent. There are so many externalities that, as an economist would call them, to homeownership. Children of homeowners so much more likely to finish high school, more likely to go to college, much less likely to be on various social programs that have a cost to the Treasury, much less likely to end up in prison. In short, the families are better off, and the communities are better off, and the public government is better off. And given all of that, it makes sense for us to subsidize homeownership and help families start on that path. But what is enormously frustrating to me is that rather than support homeownership in a fair and even way over the last decade, instead we have had government policies that essentially turned that primary instrument of wealth development, the mortgage, into a predatory instrument of extraction from working families. And that is a mistake of enormous proportions, and I want to dwell on it just a little bit. In 2003, we had the emergence of a new subprime that used a 2-year teaser rate as bait. It had a large prepayment penalty, so that was the steel trap that locked people into their mortgage. They couldn't refinance. It had a system of undisclosed kickbacks known as steering payments, in which mortgage originators received big bonuses for steering people into subprimes, even when they qualified for prime loans. You might recall that Wall Street Journal study that found that 60% of the families in subprime actually qualified for a prime loan. And finally, there was the rejection of traditional underwriting in which many of the facts in the mortgage report were fabricated, and therefore to put people into homes that really were unaffordable. So those subprimes had all the features of a basic scam. They had a bait in the teaser rate, it had a trap in the prepayment penalty, and it had fraud. And that was allowed to go on by the Federal Reserve that had a responsibility for regulating home mortgages. And indeed, I've said a lot in the past about how terrible it is. I was trying to think of a polite word for it. that failure of regulation allowed the corruption of the mortgage system. And so there we are with the biggest tool for wealth management being turned into a scam or a predatory system. And now all of us, and I praise the work that all of you do in this room, all of us have to try to figure out how to pick up the pieces. And certainly one important thing was to end those practices that constituted that predatory system. And I'm pleased to be able to say I was able to get a ban on mortgage prepayment penalties and on steering payments and on liar loans into the Dodd-Frank legislation, partly at the committee level and partly an amendment on the floor. So hopefully, and I say hopefully because there's always laws can be changed and there's always regulations that can find flexibility and pathways, but hopefully we will prevent the mortgage from being a predatory instrument as it was over the last decade. Certainly another piece of the picture was to put the financial world back on its feet. Our government responded energetically in 2008, 2009 with the federal bailout and then the 2010 Dodd-Frank Act to try to restructure and eliminate too big to fail and a host of other pieces of that. I was involved in something called the Merkley-Levin Amendment that attempted to create a modern version of a Glass-Steagall Act related to proprietary trading. Proprietary trading had a huge role both in the collapse of the banking system in the Great Depression and in the 2008-2009 meltdown. But a very critical component of this is also to tend to the millions of homeowners who were wounded by the predatory system of mortgages and then by the collapse of the economy on top of that. That piece of the puzzle has been so deeply underattended. We haven't done well. It's as if you had a massive flood and everyone rushed out to repair the dikes but did nothing about the families whose homes are flooded. Last year, families across America received 3 million foreclosure notices. More than 1 million families lost their homes. We're on pace for another 1 million to lose their homes this year. Estimates that are after this year, we may see yet from this crisis another 4, 5, or 6 million families lose their homes. And the crisis has, as Reed noted, disproportionately affected minority families. 17% of Latino homeowners have either lost their homes or are at imminent risk of doing so. For African American community, that's 11%. For non-Hispanic whites, 7%. And these disparities continue even when you adjust for levels of wealth. So we saw the U.S. government respond with great urgency and great generosity in tackling the salvation of major financial institutions, but we have seen a response both in monetary terms and kind of passion and speed has been very, very slow to respond to the plight of homeowners. Indeed, the main program, the HAMP program that was designed, Housing Affordable Modification Program, was really flawed in its design, and it's been a colossal disappointment. Designed to assist 3 to 5 million families, but it's assisted perhaps around 600,000. It was authorized with a vision of $50 to $75 billion being spent to assist families. We've put only about $1 billion out the door, about $1 billion. Compare that to the hundreds of billions that went out to assist major financial institutions to save them. It's a voluntary program for the servicer, and therefore a loan gets modified only if it's in the best interest of the financial institution, not if it's in the best interest of the family. And the application process has been, to not put too fine a point on it, absolute hell for homeowners. Families contact my offices in Oregon daily. I'm sure this is true across the country. I hear these stories from my colleagues all the time of families applying multiple times to their servicer. The paperwork is lost. Each person they talk to tells them a different story. They're given advice: stop making your payments for 3 months, or make only half your payment for 3 months, or do this or do that. Oh, we're ready to go. Don't worry about those foreclosure notices that you're getting. And then you get more foreclosure notices. And the combination of not having a coordinated single point of contact, a coordinated application process, a single repository for the applications, and then the dual track in which the servicers pursue foreclosure at the same time that the family's in the middle of modification, is a system of complete chaos. And if you were trying to design a system to maximize the stress on homeowners, you couldn't think of a way to do it better. So many stories. You can pick one of the millions. The Allen story is an example in Oregon. In September 2009, Allens were approved for a loan modification by one of the nation's largest banks. They had begun making their new payment under the modification when they received their first foreclosure notice. The bank assured them everything was fine, continue making their payments. But every time they called the bank to check in on the status of the modification, they received confusing and conflicting information. For over a year, the dual track continued in which they received foreclosure notices and were told everything was fine on the modification end. Then, just recently, they received notification of the bank that the checks they'd been sending were only partial payments and that they were not en route necessarily to a permanent modification. And so they are left still in a state of limbo, not knowing where they stand. No permanent modification, the possibility of foreclosure. And if this was just one rare story, but it is almost the norm for families that have applied for modifications. And in some cases, it almost appears that servicers have used the HAMP program as a bait. I have families in Oregon who were told they were pre-approved for modification and therefore to adjust their payments in this fashion or that fashion. And of course, what a terrible situation that is, to have the primary program for helping families being turned into one that leads them down a road into deeper financial dysfunction. So we have to do all we can to change this. And many of the points that I'll make about changing it are ones that many of us have been making, many of you I'm sure have been making for a year to 2 years. And so it is frustrating to be where we are, but we can't give up on assisting families who are deeply in trouble. There are 6 ideas I'm going to talk about. I've put them in, and Will White on my team want to make sure that everybody does. You'll see him on the panel later. So I thank his help in putting together this proposal. It's on my website, merkley.senate.gov, and I think we have a few copies with us today. But paving the way to a healthy housing market. Now, the general premise behind this is that housing was at the heart of our recession, and until we address housing seriously and the foreclosure crisis seriously, we're going to be in this recession for a very long time. But the other premise is it's just wrong. It's just wrong to rebuild the dike and not assist the families that have been flooded through the storm. So we need to, let me just start with the simple pieces that in terms of the modification program, families need a single point of contact. Several institutions have said they're doing this. We haven't started to see that from the families that are calling our office for help. But I praise them if they're taking steps in that direction or they're implementing that. Great, but it needs to happen faster and it needs to be coherent. It isn't a single point of contact if one officer is appointed to so many foreclosure cases that you can't ever reach that person, for example. And it's not a single point of contact if your file is traveling hither and yon and documents are continuously lost out of it. Second, we need to end this dual track. If a family is in the modification process and until a final decision is reached about whether they're approved or not approved, the foreclosure process needs to be completely set aside. And by that, I do not mean simply the final stage of putting a home up for auction. I'm talking about the entire set of notices. The cars arriving with notices, the person on your porch, the phone calls, the letters in the mail, it all has to be set aside until the modification process is resolved. Third is there has to be some form of third-party review prior to foreclosure. One, to make sure no opportunities have been missed. Second, to make sure that no decisions have been made based on mistaken information. And third, to make sure that no laws are being broken in a rush to foreclosure. Now, there's many different forms of this type of third-party intervention that have been discussed, and it isn't that any one is the only way to go. I applaud any of a number of models. Connecticut has allowed homeowners facing foreclosure to participate in a mediation program to help them come to an agreement with lenders. And the initial statistics from that are really impressive. Of those participating in the program, 63% were able to, of the families were able to stay in their homes. So then let me turn to another framework, and that is the ability to create a win-win either at the point of foreclosure or the point of bankruptcy. Banks are very reluctant to reach a deal that has anything to do with lowering the value of a mortgage. But at the point of foreclosure, the value of that mortgage is now dropped enormously. Or the point of bankruptcy, the value of that mortgage has dropped enormously. And so it changes the framework of the discussion. A servicer on behalf of a bank or a trust is now looking at a situation where that $250,000 mortgage isn't going to stay worth $250,000. There's no way it's going to be on their books for that. They're going to have to sell that home, and if the fire sale price for homes in foreclosure is $125,000, that's what they're going to get out of this. And at that point, there has to be a recognition that a family that couldn't pay a much higher interest, perhaps they had a 9% under a subprime loan, and it's paying that on a much higher principal, perhaps $250,000, that can't possibly afford those payments, could quite possibly afford a payment that 5% for the price at which the bank is now going to sell the home. And let's say that's $125,000 or $150,000. And so we shouldn't have a situation where that family looks by in frustration and sees that home sold at a price and mortgage that they could have afforded. And they could have stayed in that home, and they could have prevented an empty house. And this is a point of win-win, because if a bank is able to sell at the basic retail price rather than the fire sale foreclosure price, the bank gets a little better price for that mortgage or that home. The second is that the parents certainly get reestablished on a home ownership track and have the stability of a fair, fully amortizing mortgage over the next 30 years. They get those advantages that I talked about in the beginning on home ownership. The children benefit. They aren't put through the chaos of a family in deep stress and having to find their feet again somewhere else. They stay in their school. And so the neighborhood wins. They do not have that empty house. And again, I want to emphasize the bank wins. Not only do they get a better price, but they also don't put out the money that it takes to maintain an empty home and worry about vandalism of that home. So a national refi program that takes advantage of that situation is a significant point where we can try to make a difference and push forward. You do have to have a component to make this work, that you have a stress test that makes sure that families are benefiting who are truly financially stressed and we're not engaged in a strategic default. That will be essential to the financial organization, and it's a fair point. Second is, we could really use a mortgage product that has been redesigned to not place so much emphasis on FICO scores, but instead is a fully underwritten ability to pay mortgage, but de-emphasizes FICO because families that have struggled to make their mortgage are going to have set aside other bills in the process, and the FICO may not be anywhere close to an accurate representation or reflection of the family's ability to make those payments. Similarly, bankruptcy is another win-win opportunity. And current law does not allow bankruptcy judges to modify the terms of a mortgage. Allows them to modify the terms of your second house, your vacation house, if you will, or your yacht, or any of a host of other loans, any loan except the basic home mortgage. That is a mistake, because it means that there is no kind of automatic mediator in the process, and that the possibility of a bankruptcy judge adjusting the terms brings everybody to the table and brings a moment of sanity and says, yes, we'll work it out, because if we don't work it out today, we may not like the result tomorrow. And we know from the role of bankruptcy judges in these other loans that they rarely modify the terms, but that it serves as a point of leverage or encouragement for the parties to reach a decision. Well, at the time that the president was asking us to release the second half of TARP, just as I was elected, he made a pledge, his team made a pledge in writing to fight for this bankruptcy reform. They did not. They did not. They were silent. And we missed a major point to create that leverage. This can be still done. It'll probably have to have a variety of sidebars. Maybe it's done in the context of looking only backwards and not at new mortgages. Maybe it's done in the context of empowering states to make that decision. But it's worth having that debate again. But we're going to have presidential leadership to take on and really seize the moment in terms of assisting families in need. And finally, I'm proposing a permanent tax credit for the purchase of homes. Maybe only authorize it for a year or two, but in my mind, it should be permanent. And why do I say this? It goes back to that project down payment in inner Northeast Portland, where I saw that families could easily make their rent payments, could have been homeowners, but they didn't have the down payment. And in fact, they were in a neighborhood that previously had been redlined and homeownership had been greatly damaged. And of course, that was fixed. The redlining was fixed, but still the low rates of homeownership suffered from those earlier actions. And so there is a conversation now about, well, we should have a mortgage system in this country that really requires 20% down payment. Well, I got to tell you, that would be a huge mistake. That wouldn't be fixing the mortgage problem. That would be adding to the mortgage problem. And the reason I say that is because show me a working family. Now, I live in a neighborhood of 3-bedroom ranch homes. It's a working neighborhood. It's one I grew up in. It's one that my wife and I moved back to about 14 years ago. Show me a family that's buying a $200,000 house that can figure out how to put $40,000 aside. And I'll show you a miracle in my neighborhood. It just is an unreasonably high barrier to people getting on the path of homeownership. And if homeownership is going to be reserved simply for the most successful upper middle class in America, then 20% is fine. But otherwise, we have to figure out a way to help families get over that huge hurdle of the down payment and closing costs. Specifically, what I'm proposing is that you have up to a $2,500 credit, so $5,000 per family, that it requires a dollar per dollar match from the homeowner, and that if a family does an itemized deductions and exceeds the standard deduction, for every dollar you go over the standard deduction, you lose 25 cents off your credit. Now, why that dynamic, itemized deductions and down payment grant? It's simply this. We think about the home mortgage interest deduction as being a powerful force for homeownership. But if you really look at the details, it does not help families, working families, become homeowners. Here's the basic math. $200,000 house, 10% down, $180,000 mortgage, 5% in your first year of interest, your biggest year of interest. That's $9,000 in interest. That's less than the standard deduction. So the working family doesn't get a penny of assistance to become a homeowner in that situation. And that program, it's over $100 billion per year. That program is tremendous for folks who've already become homeowners to help establish wealth in their homes. But it's nothing to help homeowners or working families become homeowners in the first place. So spending a little bit of money up front in a matching form, so there's skin in the game with the families, very much like an IDA in its structure, is well worth the investment. Also, at this point, such a program could help reduce the inventory of empty foreclosed homes, help families become homeowners at a point where the homes are relatively inexpensive, coming at the bottom of the market, and help restore the housing market in general, and therefore have broader beneficial impacts on the economy. So in conclusion, homeownership is a powerful force for wealth building, for asset building. It's true for families in inner Northeast Portland. It's certainly true for families across this nation. We have deeply damaged that system by allowing it to become a predatory system. We now have to pick up the pieces and restore it, not throw the baby out with the bathwater. In the process, doing so will be right for parents, right for their children, right for their communities, and right for putting the American economy back on its feet. Thank you.